your next bullet point with the top 4 critical items is, and there's kind of a subcategory to that we'll talk about, is low fees. So holy cow, low fees, right? We never hear that term when we're talking about life insurance. Do you want to talk about that a bit?
Yeah, low fees. If you think about your life insurance retirement plan, your IUL is a bucket of money. Your money goes in. Okay, as your money grows in this sort of indexed approach that we've talked about, up to the cap and then guarantee against loss. As your money grows, your bucket begins to fill, and the IRS says that that bucket of money is going to be treated differently for tax purposes than anything else we've talked about so far.
Why low fees?
Why low fees? Okay.
Or why is
so
that?
this money, the money within the bucket gets treated differently for tax purposes than anything else we've talked about. You can touch the money pre-59 and a half. You don't receive 1099s as your money grows. When you take the money out, you take it out the right way. It grows tax-free. Here's the issue, okay? The IRS says if we're going to give you the benefit of this unlimited bucket of tax-free dollars, we're going to require that there be a cost of admission. They're going to require that there be a spigot attached to the side of that bucket through which flows on a monthly basis some expenses. What do those expenses go towards? They go towards some administrative fees, but they primarily go towards the cost of term life insurance. So here's the bottom line, Mark. Whatever drips out of your bucket doesn't stay in, right? So whatever stays in grows and compounds over time and accrues to your benefit. You get to accumulate that money, grow that money, take it out somewhere down the road when tax rates are likely to be dramatically higher than they are today, and you can spend it on your lifestyle in a completely tax-free way. So it's a great way to buffer against an increase in tax rates down the road. But if you have a policy that's, number one, not structured in the right way, and when I say not structured in the right way, I mean what we're talking about here is you want to buy as little death benefit as the IRS requires of you, and you want to stuff as much money into it as the IRS allows in an attempt to mimic all of the tax-free benefits of the Roth IRA without the limitation. If you don't structure it the right way, for example, by choosing to structure the right way, for every $10 you put in, you could have only $1 go towards fees and 90% goes towards the cash value accumulation. I've seen people structure it such that $5 goes towards fees and $5 goes towards accumulation. These products, frankly, just don't work if they're not structured in the right way. You got to get as little life insurance as the IRS requires of you, stuff as much money into it as the IRS allows. So that is a great way to reduce fees, but there's also, not all IULs are created equal. The main premise of my book, Look Before You LERP, you see there's 2 wedding rings on there. I basically make the case that starting an IUL is a little bit like getting married. It only really works if you keep it until death do you part. And Mark, we joke about this, but I don't think any of us got married after the first date. We all actually dated our spouses for a while. Why? Because we had a laundry list of things we were looking for in a spouse, and we want to make sure they checked all the boxes, right? Well, you should have a laundry list of things you're looking for with your IUL. And one of those things is low fees. Just like not all spouses are created equal, not all IULs are created equal, and they have different levels of fees based on the company. And so there's all these different stars that we have to align, but one of those stars is we want to make sure that the fees are as low as they can possibly be. That's a function of structuring the policy the right way and getting the right company, because whatever drips out doesn't stay in and doesn't accrue to your benefit over time.
I don't know if it was knockout or must-haves. What is it? What is that internal
deal breakers
process?
Yeah, deal breakers. There's a list of 26 deal breakers that a guy named Brett Anderson compiled.
Right.
And these are things that you would not ever think of on your own. Okay, these are very sort of obscure provisions in these life insurance policies that you could have, unless you're an attorney and you're reading through all the legalese, you wouldn't even know what to look for. So this guy has sort of ferreted out these 26 different attributes that your IUL must have. I list 8 attributes in my book, but this guy's gone really, really into the minutia, and he's come up with 26 different. What he says is, if your IUL doesn't align with all 26 of these metrics, then it's a deal breaker. You should not get married to that IUL. Should not get married to that that LIRP. And so the IULs that you and I deal with on a regular basis are number 1 and number 2 on that list. Okay, so they don't have any deal breakers. And there's one tiny deal breaker in one of the companies that we use, but when you really dig into it, It doesn't really have any bearing on any real life situation. And the company we use has even done a little tweaking to sort of compensate for what is that, that perceived deficiency. So really, there's two companies out there that don't have any of the deal breakers, and those are the ones that we really use to set our clients up for, a successful experience over a 30 to 50-year time period.
Yeah. Yeah, and I think that company, and we're specifically not mentioning the company because we can't do any direct recommendations on these channels as I talked about, and I think that company made some changes because of your influence, Dave. I'll give you the credit for that. The next thing on the list here I have is tax-free and cost-free distributions, and this is the powerhouse, right? This is a powerhouse behind these structures. So let's talk about that a bit.
Yeah, this may be the very most important provision in the entire contract, and this comes down to how do you get money out of these contracts? And one of your goals is to build money up so that somewhere down the road you can take money out and do so in a tax-free way. How exactly do you do that? And the way you do it is whatever money you've put in, you can take out tax-free because you're using after-tax dollars in those contributions. So let's say you put in $100,000 over 5 years. And that $100,000 grows to $500,000. The IRS says that you can take your $100,000 in first out, and you can spend that completely tax-free. But what about that $400,000 of growth? That $400,000 of growth, the only way to get that out tax-free is by way of a loan. Okay. Now, a lot of us are familiar with whole life policies. And whole life policies, you take a loan from your whole life policy. You're not really taking it from your policy. You're taking it from the insurance company, and you're using the cash value in your whole life policy as collateral for that loan. The problem is with these, there's another reason why I'm not a big fan of whole life, is sometimes they can charge you loan interest rates as high as 8%. So it's almost as if you were taking that loan from your bank. Now they do credit back something in the form of a dividend, but if that dividend is less than 8%, and it often is, you can end up having a net cost of borrowing of maybe 4% per year, which is not awesome over a long period of time. What happens with IULs is you can get what's called a 0% loan. And what that means is that you are borrowing money directly from the company using your cash value as collateral. They do charge you a real rate of interest, say 3.5%, but they will credit right back to your cash value in equal amount of interest to offset the cost of that loan. So they may charge you 3.5%, but they'll credit you back 3.5%. I've never been great at math, Mark, but I know that if you always have 3.5% credit, 3.5% charge, that's going to net out at zero. Now, some companies, to be fair, will start off with a net 0% loan, but reserve the right to change that to 1, 2, or 5 at their leisure over 30%, over 30-year time period. And I tell people all the time, if you give an insurance company 30 years to make up their mind what they're going to charge you, it's not always going to work out in your favor. And so I absolutely insist when it comes to our LIRPs, our IULs, you absolutely have to have that guaranteed, that 0% loan guaranteed in the contract. In other words, what they're charging you is guaranteed. What they're crediting you is guaranteed. So like I said, if what they're charging you always going to be 3.5%, what they're crediting you is always going to be 3.5%, the net result is there's no cost to you for borrowing that money. So it feels like a tax-free distribution from a Roth IRA because you asked for the money, you got the money, your cash value went down by the amount of the loan, and you didn't have to pay tax along the way.
Now, the last one you have listed for this section is a cost-free long-term care rider. Let's talk about that a bit.
Yeah, one of the huge reasons why our clients, frankly, adopt an IUL, adopt the strategy, is because it's a heartburn-free way to take care of long-term care. What we know about traditional long-term care insurance, it's sort of going the way of the dodo. Why? Because nobody wants to pay for something they hope they never have to use. And what happens with traditional long-term care insurance is there's a lot of, frankly, downsides. Number one, it's expensive. It's getting more and more expensive all the time. Number two, it's hard to qualify. You might pay for 30 years, but if you die peaceful in your sleep, never having needed it, they don't send you all your money back at the end. It goes to pay for someone else's long-term care. And the last one is, so it says it's expensive, hard to qualify. It's hard to qualify for. You might live to be 120, but if you have a bad back, bad knee, bad hip, you may not even get accepted. So those are 3 strikes against traditional long-term care. What we know with the IUL is that it's not it's underwritten based on mortality, not morbidity. In other words, it's the likelihood you're going to die, not the likelihood you're going to need long-term care. And if you pay for 30 years, or you even pay for 10 years, let your money grow for 30 years, die peaceful in your sleep, never having needed long-term care, someone's still getting a death benefit. It's probably your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. So the IUL has the ability to mitigate the long-term care risk, which is frankly a big one, without the heartburn that goes along with traditional long-term care insurance. Now, there's two ways to do this. You can do it by way of what's called a long-term care rider, or you can do it by way of what's called a chronic illness rider. Now, a long-term care rider, you're actually paying for, okay, just like you would a traditional long-term care policy. They take your drops coming out of your spigot are bigger than they otherwise would be if you adopt a long-term care rider. You're paying for it. And if you die peaceful in your sleep, never having needed long-term care, you lost all that money along the way. With a chronic illness rider, they don't charge you anything along the way. But on the back end, when they give you your death benefit in advance of your death for the purpose of paying for long-term care, they'll discount that slightly based on your age in which you receive the benefit. So instead of, for example, getting $10,000 a month, maybe they'll give you $9,500 a month or $9,000 a month, because you are technically receiving your death benefit prior to your actuarial life expectancy. So they reserve the right to sort of slightly shrink that death benefit because you didn't quite reach your actuarial life expectancy. But so the long-term care, so if an IUL checks all the boxes, but they only have a long-term care rider and they don't have a chronic illness rider, that's still a deal breaker for me, because I need to have I don't want to have to pay all those drops along the way and needlessly spend money on something that I'm hoping I never have to use.
Yeah, and I could give so many examples of folks who are depleting almost everything using long-term care or paying for long-term care. So we have a really good relationship with a local attorney who's an elder law attorney. And when I talk about building your retirement team, I always suggest that someone around retirement age have their estate planning attorney or their estate attorney be an elder law attorney, because there's likely going to be that need for one of you during your lifetime. But it is not uncommon to see people just spending down every nickel they have. And I was recently, again, this is another common conversation, but I was recently speaking to someone who contacted us, who lives in another part of the country, and she said, "Well, I'm in the process of buying putting a lump sum of money into a long-term annuity contract." And she said, "So would I still need the life insurance with long-term care rider?" And the reality is, you're going to need as many levers as you can pull from to pay for long-term care when the times come. So it's not an either-or proposition. Now, I wouldn't recommend a traditional long-term care policy for all the reasons that Dave spoke about it. But if you can have a long-term care annuity, if you can have a life insurance policy with a long-term care rider, and you're going to have your own savings that you're going to have to spend too, because we see anywhere from $8,000 to $15,000 a month people are spending for long-term care needs. And that's today in 2024. Now, if you really want to keep yourself up at night, you can search the Genworth cost of care tool, and you can move a bar from today's cost. You put in your zip code, it tells you what the cost of in-home care, adult daycare, long-term care, assisted living. There's a really, really great tool. And then if you really want to add some pain to your life, you can slide that bar over for the next 20 or 30 years and see what potential cost is. So that's a real risk that we pay attention to all the time. So you're going to need just about everything at your disposal for that. And we talk about the power of these life insurance policies, and the issue that we have is that, first of all, we're working against bad information and bias in many areas, including Google and YouTube and Susie Orman and Dave Ramsey. But you also have to get approved for these things, right? So anybody can open up a Roth IRA. Anybody can do a Roth conversion who has money in a traditional IRA, but not everybody can do a life insurance policy. And it is a fantastic tool. So if it's something you're considering, don't delay and just at least going through the application process. Caps on variable loan interest rates. Do you want to talk about that a little bit more?
Yeah, so there's we talked about the guaranteed 0% loan. It's probably my preferred way of taking money out of it, but there's another way to take money out, and that's through what's called a participating loan or a variable loan. And what happens is, instead of so you ask the insurance company for a loan, and instead of charging you a guaranteed 3.5%, they're going to charge you a rate that can ebb and flow. Okay. And it's linked to the, forgot which index it's linked to, the one in England. It's linked to an index, and some companies don't have any caps on what they can charge you. Okay. So they may charge you as high as 10%. Then what are they offsetting that loan charge with? Instead of giving you, say, a guaranteed 3.5%, they're gonna simply credit you whatever your index did that year. So if your index, let's say they're charging you 5 and the index did 10, that means they're literally paying you 5% that year to take the loan, which can be great because that means that your money is growing and compounding even as you're taking the money out. The problem is if you have a company that doesn't put a cap on what they're charging you, the amount that they charge you could actually most years be greater than what they're actually crediting you, in which case there's what we call negative arbitrage. There's a net cost to borrow, which of course flies in the face of everything we're hoping to accomplish. So this is really pretty straightforward. Instead of doing a guaranteed 0% loan where they're charging you 3.5 and they're crediting you right back 3.5%, we're saying that they're going to charge you, for example, maybe up to as high as 5%, but never higher. And they're crediting you back whatever your index happened to do that year. And in theory, that number most years should be higher than what they're charging you, in which case there's a positive arbitrage for having undergone that loan. But you want as many guarantees in these products as you can. And you don't want to give these insurance companies any wiggle room over the course of, a 30 to 50 year period.
Yeah. And the next one is something I just don't think many people consider at all, and that's interest in arrears. And it can really make a big difference. And that's these are your charges we're talking about. So Dave, can you talk about that, please?
Yeah. So interest in arrears means that they are not they're not charging you for the loan at the beginning of the year. They're charging you for the loan at the end of the year after you've already accumulated the money that's going to offset the cost of the loan. So the opposite of interest in arrears is interest in advance, which means they're taking money out of your cash value at the beginning of the year to pay for the cost of that loan versus letting your money accumulate over the course of the year and then taking that money at the end of the year. It doesn't seem like a big deal, but when you do this year over year over year, it ends up taking a toll. In fact, what I tell people, and this is the math bears this out, you can have a guaranteed 0% loan, but if it's interest in advance, it's like adding 40 basis points or 0.4% to the cost of that loan over time. And so there's 3 different types of loans I talk about. You can have a 0% loan, which is in advance, which is sort of like having a 40 basis point. And you can even have that guaranteed, but it's still a net 40 basis point. You can have interest, you have guaranteed 0% loan with interest in arrears. Sorry, you can have a 0% loan with interest in arrears, but they can reserve the right to change that to whatever they want. What you really want is you want a guaranteed 0% loan with interest in arrears. That's perfection. That's what we're looking for. And we only do business with companies that offer those types of things.
Dave, talk about a stable index cap rate.
Yeah, since I wrote the book, Look Before You Lerp, I've backed off of this a little bit. There are some companies out there who will lure you in with a high cap rate, say 14% or 15%. But the minute they have you in their clutches, they're going to lower that to 8% or 7%. There are some companies that do that. However, most companies are just reacting to whatever variables are happening in the marketplace. So you definitely want to avoid the companies that lure you in with a 14% cap and lower it to 8 or worse once they have you in their clutches. There aren't very many of those companies, and certainly the companies that we work with don't do that. So this is, in retrospect, this one's not as high on my list, but it's definitely something to watch out for.
Dave is a financially stable company. So this seems really obvious, but let's talk about that a little bit because it can sneak up on people.
Yeah, at the end of the day, you could have a policy that has all these great provisions, all these great guarantees, but guess what? If your company goes bust, you're never going to lose your coverage because some other company is going to swoop in and buy out that company's book of business. And that new company that buys out the book of business of the old failed company is under no contractual obligation to honor any of the guarantees in that contract. And so those guarantees are based upon the claims paying ability of the company you started with. Okay. So that's why it's so important to basically have a bona fide metric of the financial strength of any given life insurance company you plan on doing business with. There's lots of different, there's Moody's, there's the S&P, there's all sorts of different ways to do this, but I much prefer what's called the Comdex rating. And the Comdex rating, if you think back to school and when your kids are in school, and they said your kid is in the 90th percentile for math. What does that mean? That doesn't mean they got a 90% on the test. That means that statistically speaking, they're better at math than 90% of the other students in the class. Okay. The Comdex rating works exactly the same way. If your Comdex rating is 95, for example, that means that you are stronger than 95% of the other companies in the marketplace. Okay. So we only do business with companies that have a Comdex rating of 90 or above. And the two that we really prefer, I think, are both 94 and above. And so really you can't compromise on that part of it, because it doesn't matter how good all of these other provisions are. If at the end of the day, they can't honor those guarantees because they've gone belly up because they weren't financially stable, then it's all for naught. So it's really, that's something that undergirds the entire proposition here, is their financial strength.
Overloan protection rider. So this is vitally important. And it talks a little bit about we have a question from Jerry, who wrote, will you address overfunding policies and staying non-MEC status? So these two aren't really the same thing, but they talk about the same thing. So anyway, let me let you take an overloan protection rider.
Yeah. So one of the Achilles heels of any life insurance policy is you have to have at least $1 in your cash value when you die to maintain the tax-free nature of the entire proposition. So if you, for example, loan a bunch of money out, you loan too much money out, and maybe you don't have great returns, whatever, your returns lag over time. And so a combination of poor market performance and these loans causes your cash value to go down to a certain point. It can actually go into a death spiral from which it never recovers. And if your cash value runs out, and that's not a very likely proposition, particularly if it's funded properly and it's being managed properly. So, but it is a possibility. So if you don't have at least $1 in your life insurance and your cash value when you die, then all of the taxes you got out of along the way all become due all in 1 year. And so you get a 1099 from the insurance company that says you have to pay all those taxes that you missed out on along the way. You got to pay them all in 1 year. And that can be a pretty rude awakening for people who get it. And so because this has historically been one of the big Achilles heels of life insurance policies, enterprising, creative, outside the box companies have done something to sort of mitigate that risk. And they have what's called an overloan protection rider. So if your cash value gets down to a certain point, the alarm bells go off in the home office and they send you a letter that says your cash value is dangerously low through this combination of variables. You now have the ability to trigger this overloan protection rider. And what they'll do is they'll reduce your death benefit. They'll basically pay up the policy, take it over, and basically ensure you can't take any more money out at that point, but that basically ensures that you will never receive that tax bill from the IRS. It becomes a paid up policy, and the death benefit, whatever's left of the death benefit, goes to your ears at death, but you can no longer take money out, but you're no longer faced with the prospect of having to pay that phantom tax bill that comes from the IRS.
Yeah, so let's talk a little bit about Jerry's question, just to give you a background. So Jerry is a retired registered investment advisor, and he's a regular on our like a regular listener on our webinars. And what Jerry's question is, will you address overfunding policies and staying non-MEC status? So I'd like you to talk a bit about, and you just touched on it, what a MEC is, right? And then the overfunding of the policies. And I think what Jerry's talking about is how we design the policy so that we're overfunding it, but not overfunding it in a way that's going to trigger this MEC, modified endowment contract.
Yeah. So I touched on this previously, I said, when you're structuring these policies, it's all about structuring it the right way. You want to reduce fees as much as you possibly can because whatever drips out doesn't stay in and doesn't compound and accrue to your favor over time. So what you want to do is you want to buy as little life insurance as the IRS requires of you, and you want to stuff as much money into it as the IRS allows. Okay, so we want to mimic the tax-free benefits of a Roth IRA. So when I say you want to buy, you want to stuff as much money into it as the IRS allows, that means that presupposes that there is a limit that the IRS allows you to put into these buckets relative to the death benefit, right? If you put in more than what the IRS allows, then this becomes what's called a modified endowment contract. And that means that you can no longer take those tax-free loans, okay? It's no longer a tax-free, it goes from tax-free to tax-deferred and basically starts functioning like a non-qualified annuity. And that means that a lot of the benefits that were the justification for doing this policy to begin with go out the window. So you don't, in the context we've been talking about here, we don't want to have a modified endowment contract or a MEC. So we're very, very clear on how much money we can put in relative to a given death benefit, and we always want to maintain that ratio. It keeps expenses as low as possible, but it also stays us out of the danger of having this thing turn into a MEC, and there's lots of unintended consequences that go along with that.
Yeah, and it's something that has to be reviewed every year. So I always talk about you should review your financial plan every year. You should have, you should review that. In that, you should be reviewing your beneficiary designations, of course, your Roth conversion schedule. If you're doing Roth conversions, your investment allocations. But part of it also is when we're doing that annual review, we're looking at the funding of your life insurance policy or taking withdrawals out of your life insurance policy. There are times that people ask, and it's the most common question is once they get set up in the life policies and they start seeing some returns and they start seeing some growth in cash value, they say, well, geez, how much more can I put into this? Right. And the reality is probably not much more than we originally set you up for, because we are trying to overfund it, like Jerry had talked about, because we want to get that money growing as quickly as possible in that tax deferred and eventually tax free bucket. So and it is good to see. I shared with a client yesterday that Sunday I was working through my own financials, and I was updating my life insurance policies, and I was very pleasantly surprised to see my cash value of my life policies. So that's really nice to see that work. And I love to see it working for clients, of course, too, but I like to see it working for myself as well. It's kind of nice to see. But there are these corridors or kind of guardrails that are put on these life policies. The IRS says it can't just be a tax scheme, right? You've got to follow these rules. The last thing on your list, Dave, is daily or weekly sweeps, and we're just talking about the investment sweeps. Why is that important?
This is a little bit more of an obscure provision, but we talked earlier about these call options that companies buy to be able to give them exposure to an index up to a cap with a guarantee against loss. These work best when they do them in bulk, right? So you buy these options in bulk. You don't do them onesies and twosies. You take massive amounts of premium, and with a portion of that premium, they go out and they buy these call options on a grand scale, so that they can create this safe and productive growth inside the IUL's cash value. Some companies are small enough that they aren't able to accumulate enough money to be able to have the economies of scale to be able to purchase those large scale bundles of options. And so what they do is they let money accumulate in an account. It's called a sweep account. And they may have to let that money accumulate. These are all the cumulative premiums of all of their policyholders, all their IUL policyholders. They may have to let that accumulate for a month. The worst I've seen is 6 months. And what's happening in terms of opportunity cost to your money if it's sitting in a sweep account earning next to nothing for 6 months? You're losing money over the long term. You amortize those inefficiencies out over the life of the IUL. That can end up really, really costing you. And so we only really do business with companies that have either daily or weekly sweeps, preferably daily. And that means that these companies are big enough, they have enough premium coming in where they can go out and buy those options literally on a daily or weekly basis. Your money's not sitting around, losing opportunity costs. It's getting put to work pretty much right away.
Yeah, and the money's sitting in a fixed account. The fixed accounts are pretty juicy still right now, but that's going to change very rapidly. So some of the conversation that we've had with clients, I can get 5% in a money market. That's in maybe even 6 months from now, that's going to be very different. So that is very important. These are kind of obscure things Dave was talking about, just picking out a couple of them. Interest rate and arrears is something most people will never consider.
Folks, my upcoming book, The Guru Gap, How America's Financial Gurus Are Leading You Astray and How to Get Back on Track, is now available for pre-order on Amazon. Take the opportunity to order your copy today. Also, in the next 10 years, I'm looking to put 1 million Americans on the road to the 0% tax bracket. If you would like some help implementing a balanced, comprehensive approach to tax-free retirement that shields you from the impact of higher taxes down the road, head on over to davidmcknight.com and click on the Connect with an Advisor button. I'm happy to refer you to an advisor in the Power Zero network that has been trained, vetted, and qualified personally by me. If you're a financial professional and want to learn how to become a certified Power Zero advisor, head over to powerzero.com and opt into my free video series. And if you have any comments or questions, feel free to drop them into the comment section below. I'll respond to every single one of them personally. And don't forget to click like, subscribe, and the bell so you never miss a video. This is David McKnight. I look forward to seeing you on the next video.